We made over $7 million in distribution income and another $7 million in capital gains income. People tell me that a mutual fund is managed. I say, yeah, it's managed by the mob. Whatever the mob says, that's what the manager does.
So it seems like you have a working strategy. Why you closed the fund that you had?
They don't understand me.
You didn't want to go down that rabbit hole, but I actually wanted to, because I think
I could tell. I've never had to do this, but I'll try.
What are your thoughts on the cryptocurrency market?
So my advice to people is,
in today's episode, we're talking to Steve, a veteran portfolio manager who now teaches how to be income independent.
you'll learn how this one lesser known fund type can boost your passive income.
Stick till the end to uncover trading secrets from his extensive 40-plus year career managing other people's money in the stock market. Steve, what's an opinion or belief that you hold that most people might find surprising or controversial?
well, in my field, which is the field of the stock market and bond market and things like that, my feeling that the income production of a person's portfolio is much more important than the market value of that portfolio at any point in time. And that's really a pretty, to me, it sounds like a very ordinary statement. Sure, that makes sense. But to most of the financial community, they're really more focused on the growth of market value than they are in the growth of income.
Income producing or income production, could you explain that to people who are not aware what that means?
Sure. The markets are made up of two different types of securities, right? And mostly issued by corporations and some by governments, but they are stocks and bonds. Stocks represent an equity interest or an ownership interest in the business. And companies, most successful companies that have been around a long time, will pay dividends to their share owners. Some of them will pay larger amounts than others. And in my past, when I dealt primarily with common stocks, I used to only buy those kinds of stocks that paid dividends, mainly because I guess it always was part of my structure that I always wanted to get something back from any investments I made. And the other, that it just seemed to me that the owners of that, or the managers or CEOs, officers of that type of company that pays dividends, had a lot more respect for the ownership interest of the shareholders than those that didn't pay dividends. I mean, they're quick to pay themselves a couple $1 million a year, but we, the shareholders, are the ones that gave them the initial capital to run this thing in the first place. So we should be getting a piece of the action. Mm-hmm. That's always been my stance. On the other side, corporations and governments issue debt securities. They borrow money by all know about treasury bills and treasury bonds, and every country has paper that you can purchase. It's a debt. You give them your money, they give you interest plus the principal back at the end. Corporations do the same thing. They have hybrid securities like convertible bonds, convertible stocks, preferred stocks. All these things pay some form of income. The majority of the focus of the world's stock markets is on high-flying, fast-growing companies, and they have a tendency not to pay dividends. But they also have a tendency, when they borrow money, to pay higher interest rates because they haven't proven themselves as profitable. So, it cuts both ways. I focus my investments, like I said, on income production, and I do it by owning securities that are not like common stocks that we just talked about, but are trusts that will own portfolios of stocks. And as pass-through trusts, they must give to their shareholders 95% of all the money they earn. So I'm feeling really good about that because, I'm getting a large sum of money for my money in return, instead of owning a bunch of individual stocks, let's say I owned 100 and 200 individual stocks paying an average of 4% dividends. I mean, that's what I'd be getting, 4%. But if I own a single closed-end fund, it's a type of fund, which is a trust arrangement, I'm getting all that 4%, but I'm getting it multiplied because they own so many more shares than I do, or I would. So I'm
Right.
getting all of the income from that and all of the trading profits from that. And the one other thing about these trusts is that, and how I get more money is that they also, just like a corporation borrows money to build buildings or to pay its executives or whatever it borrows money for, these trusts borrow money also, but they're not building anything. They're just buying more dividend producing securities. So that's how
How?
they multiply the amount of income they can pay you.
Right. How?
So
How?
for,
Sorry. Go ahead.
I think
so for
I
the
confused things more than I cleared them up, right?
yeah, I think
But
No, no. I
just
think
to
there's a lot to
yeah, a
unpack
lot to
there.
unpack. So just for someone who's not super familiar with the stock market or you know, these kinds of legal entities, could you explain at a high level, first of all, what a trust is and then how it operates within the stock market?
And yeah, and I was going to add on to my question as well, so you can answer both because I think it's related. I was going to ask, how are trusts different than ETFs and
Yeah.
mutual funds?
Oh, okay. The closed-end funds, the trusts that are called closed-end funds, are different in a couple ways. The closed-end funds are much more like stocks. For example, let's say you have a Amazon stock or IBM or something like that. When it trades in the marketplace, it's all based on supply and demand. The company will have a book value, but there's no way it trades at its book value. It trades at whatever, how popular it is today, tomorrow, what the news has been, blah, 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 whatever is going on. That's the same with a closed-end fund trust. It trades based on demand for the trust, for the management itself. A closed-end fund and an ETF, they pair their price to what's called the net asset value. Net asset value is exactly the same thing as book value in a stock, but it's the net asset value of the securities within the trust, within the ETF, and within the mutual fund. CEFs are not designed to trade at their net asset value. No effort is made for parity, whereas every day the other two mark themselves to the market price of the security price equals the net asset value. So they add shares or they take away shares to make that happen. Closed-end funds don't do that. They just
Is
like a
that a good
stock.
thing or a bad thing?
I think it's a great thing. I mean, I wouldn't. If you had stocks trading at their market or at their book value, you wouldn't have nearly the excitement that you have now in the trading possibilities and that. If you marking it to market is kind of artificial in my mind with the ETFs and the closed-end funds. And this, by the way, in 8 or 10 podcasts, it's the only time anybody's raised that question in quite the same way you did, and it's really a good way to look at it. So I hope I've explained it. So yeah, the idea is it really builds on the focus of what these things are all about. The focus of an ETF, the focus of a mutual fund is to grow the market value. Just like the focus of someone who manages a portfolio of stocks. Most professionals are most interested in raising their amount under management, and that comes from raising market values. Whereas a closed-end fund manager is there, and his goal is to produce as much income as he can for his shareholders. So it's a totally different ballgame.
You can explain if I got that right. So the reason it's good to invest in a CEF, it's a good thing, is because it gives you an opportunity to take advantage of the fact that there might be like a event like a new war or something that started that might cause the value of CEF to drop, where you can come in and buy the
Well,
trust
the
because it's
same thing.
artificially dropped?
No, it's not artificially dropped. The same things that affect the stock market, this thing you just mentioned, the war, the pandemic, uh, elections in important countries, all affect the stock market. And the closed-end funds own stocks and bonds. They own the same securities. So whatever's going on in the world is going to have the same impact on the prices of both types of securities. But
Okay.
the reason that they are attractive is because of the income they produce from the very same securities. They produce much more income than the others, and that's what makes them attractive to people who need income.
Wait,
Okay,
yeah. So
like
I
an
think okay,
old young
okay.
people,
Hold on, Erica. I
young
think
people like you have less of a need to think about retirement income than an old guy like me, right?
right. No, but what that's what I'm trying to understand. Like ETFs also, like if the underlying stocks in an ETF are all dividend paying stocks, right?
Hmm.
They would also produce a lot of income. No.
Well, not a lot. They produce income certainly, and there are some. I have a portfolio relatively of 240 securities that I own and that I trade and that I used to own for my clients when I had clients. And I actually owned 8 ETFs. 4 of those ETFs contained nothing but closed-end funds, and the other 4 were ones that did covered calls, and one of them did BDCs, which is another type of investment product. But those 8 paid significant income. But on average, the average ETF and the average mutual fund pay less than 3%. I
Why
mean, you
is
can
So,
that?
cherry pick.
I still don't
Why
understand
is
why.
that?
Why is that? Yeah.
Because the focus. I mean, you're not going to. Mutual fund managers aren't going to take profits to add to their income. Either ETFs are passively managed for the most part. They're just now starting to be managed at all. So they just sit there. If the price goes up, the price goes up. Whatever dividends come in, that's what they pay you. A closed-end fund manager is he's putting all the money he gets from the initial public offering is going into a portfolio of stocks, and then he's borrowing probably 35% of his total net, and he's buying another, adding to that portfolio of stocks, and the price is determined on the number of shares that are available, not on the net asset value of the portfolio. So the income is coming from a larger number of securities than it would be if there was a 1-to-1 ratio between shares and net asset value. Picture your own portfolio of securities, okay? And you, for whatever the worth they are, they're gonna pay you these dividends. Then through some other mechanisms, somebody's going to throw in another 40% of every one of those securities. Just obviously, that means those securities are going to pay more money than they were paying, right?
Wait. So where is that
40%.
40% coming from?
Because the trust is borrowing, either selling preferred stock or borrowing from banks short term to buy additional securities that you haven't paid for. So
I see.
there's more securities, there's more shares than they would have just gotten from the dollars the shareholders themselves put in
I
initially.
see.
It's
So
really it's not the it's not the where your focus should be moving is that there's no real difference in what's inside CEFs, mutual funds, and closed-end funds. There are 2 basic differences. A, the CEFs do not trade at net asset value, and B, the CEFs produce significantly more income than the other 2, and that they've been around in the case of ETFs for 120 years longer, and 20 or 30 years longer than mutual funds. So they're not a new thing that I'm picking out of the air to talk to people about. This is an approach that's been around all along. But the reason it's not popular is because you're not going to go out and make a fortune and growing market value with it. You're not going to have an Amazon or a Google or something like that type run up on these things. It's just not going to happen. You're going to own Google and Apple and all those things within an equity closed-end fund, but it's not going to be just one company that you're focusing on that's going to make you rich. You're saying, I don't want to take that risk anymore because, I look at all the records and 90% of all IPOs fail. These other guys, the ones that have made it really big, but most of them don't work much at all. So I'm focusing on my retirement. I'm focusing on my income, or I'm a young guy and I got to put my kids through college and I want something. I don't want to pay that out of my assets. I want to pay that out of the income produced by my assets. That's where CEFs are important.
Right. No, I understand now.
Okay.
Yeah, but my question is, if the fund manager is borrowing money, doesn't that make the CEF more risky compared to an ETF, a standard ETF?
No, standard ETF owns common stocks and every one of them borrows money.
But they're passively managed, right?
They're passively managed, but the managements of the companies that are in there are all borrowing money, aren't they? Every company on the New York Stock Exchange has debt.
Right. But the CEF.
So CEF is the same as anybody else. They're just not borrowing it to build buildings. They're borrowing it to buy securities. But they all borrow money. And there are fewer shares, and that makes them more volatile than the unlimited supply of shares of everything else, of ETFs. And I'm not putting down ETFs or mutual funds by any means. They have their purposes, they're well managed, and they're good investments. They just don't produce the kind of income that closed-end funds do. And that's why I focus on them, particularly in my book. The whole book is based on these differences that we're talking about to show how the closed-end funds versus ETFs like SPY and mutual funds over the years do not produce enough. And I know we're going to talk about this later, about that 4%, the 4% that we all think is the right amount that you should be taking from your portfolio in retirement. I think that's a great number. It's a good number to work with. But where does it come from? Okay. In my program, I make more than 4% in income to provide that money to the person and to allow that person to continue to grow their portfolio income. Whereas in the normal portfolio, since it doesn't produce that much income, you have to sell securities to produce the income you need, because you're not going to have enough income. And not only that, in most managed programs and most individual programs, people reinvest all the dividends they receive from their securities anyway. So there you have the situation where even if the market is going up and up, they still have to sell to provide you the 4% because they've reinvested all the dividends and there's no cash there to pay it with. So what they normally do is they sell the ones that are down in price, not the ones that are up in price. They rarely take profits. That's the other aspect of the Retirement Money Secrets program, is that we take profits. I mean, I thought, like I've taken in the 3 days, the 3 days the market's been open this year has not been so great. I've taken $1,000 in profits for myself every day.
Right.
Because they're there.
Yeah. No, I want to, I know you didn't want to go down that rabbit hole, but I actually wanted to, because I think
I could tell.
at the very least, people who are watching this, they'll at least, even if they understood just one thing, my goal would be for them to understand like 100% why
About
CEFs are better than ETFs, right?
okay,
And but to make a legit case, we need to make
hmm
sure that Eric and I 100% understand what's under the hood, right?
okay,
So
right,
I still have some lingering questions, if it's okay with you,
okay.
to further clarify my understanding. Eric, I'm sure you still have some as well,
Yeah.
It's
right?
sure. Go right ahead. Yeah.
Okay,
Well,
let's
and
start out. Let's start
one
out on the
clarification. One clarification first. I'm not saying I'm not saying they're better. All I'm saying is they're better income producers. They
right,
contain the same securities that are in those other forms. Okay.
right. So
Same.
the question is,
We're all dealing with the same stocks, the same bonds, the same municipal securities. It's just a different structure and a different purpose. The purpose of the other managers is to grow the portfolio market value. The purpose of closed-end fund managers is to grow the income, and they have to distribute 95% of that income. So it's literally impossible for them to make the same growth in market value because they're giving all their income away, whereas the stocks and bonds and everybody else are reinvesting that in their company.
right.
Okay,
So
and
so
they maybe go ahead.
I
Now
wanted to
go
like
ahead.
break it down so everyone can understand this, right? So let's say we take a CFE on the left side and ETF on the right side, right? And say
Yes.
they only have two components, right? CFE has Apple stocks, right, and Amazon stocks, right? And it's the same thing on the ETF side. They have Apple stocks and Amazon stocks, and say both of them pay say 5% dividend, right? So now, can you explain how the manager of this CFE will behave differently than the manager of an ETF with the same
Uh,
two stocks in their portfolio?
okay. All right. I can't. Yeah. First of all, they're CEFs, not but
Oh, CEFs. Okay,
uh,
closed end funds.
but
Yeah, sorry.
but neither entity would own only two securities.
Right. No, this
All
is
right.
just to oversimplify so people outside
Yeah, it's
finance can
really
understand.
okay. So they both put they both have. I've never had to do this, but I'll try. Okay, so I might mess it up. I don't know.
No, well,
Okay,
yeah,
so
let's give it a shot.
so okay,
Yeah.
so they both have the same securities. That's fine. They both have they both are structured. How did they pay for those securities? They paid for the securities with the money they got from selling shares to the public. All right. They both come out and they sell the shares to the public. So the ETF manager has X number of shares, and so does the closed end fund manager. Okay.
Yeah, let's call it
And
100
these
each.
Okay, 100 shares. It doesn't matter. Okay, so
Yeah.
then the closed-end fund manager is going to go out and he's going to borrow 35% of whatever he put into this enterprise, and he's going to
Right.
buy more of those shares. So now he has 140 shares of the whatever stock it is, and the
Okay.
closed-end and the ETF manager still just has 100 shares.
Ah, that makes
Okay.
sense. I think that was a good experiment. So Erica, I know you are outside finance, so it's
Yeah.
now clearer to you?
Yeah, I mean that makes sense. Another very basic question. So the motivation behind borrowing money is to grow the whole pie in order to grow the income
To grow the income, yes.
ultimately.
Yes.
Whereas the ETF
Right.
manager doesn't want to borrow money because he wants to make sure that
I don't
is
I don't think he can under that form,
okay.
under the structure of an ETF or closed-end or A mutual fund. I
Okay.
don't think they have the capability of borrowing to increase their asset base.
Right. That
Okay.
was my understanding as
Okay.
well. They're passively managed, so that no one is actively messing
Okay.
up with the
The
underlying stocks.
But the key element, guys, the key element is that with exactly the same underlying securities inside these various products, this product pays much more dividend, puts it in your hands, into your pockets that you can spend than either of the other ones. And they've been doing it for years and years and years. And
Yeah.
it's a great tool for income focused investing.
No, that makes sense now. So the question now becomes like, when the fund manager is going outside and borrowing money, there's fees attached to it, right? Where is that coming out of?
Well, he's borrowing short term. It's just like you and I would do. When, for example, when interest rates were about zero, most people refinanced their mortgages, right? Because they could get it cheaper and they could do better with their money. What I did is I borrowed more on my home and I invested in the closed end funds that were paying me 7%. And my mortgage is less than 3%. That
Right.
made a lot of sense to me. Add to the mortgage. And it's the same with them. If I'm a manager of a fund and interest rates have just skyrocketed, that's in quotations, to 5%, which is pretty much a normal level. And now if I borrow money at 5%, I have to find something to invest in that's paying me at least 6% to make it worthwhile. So if I can't do that, I'm not going to borrow the money. So the argument that this borrowing, this leverage is difficult and dangerous is really only if you have a bad manager who says, I'm going to borrow the money anyway, regardless of what I can get for it. That would be foolishness, wouldn't it? So
Right.
why would they do that? So in an environment like this, and until it stabilizes, what's happening now is that we had this downturn in interest rates, this remarkable, historically low interest rates for years and years and years. These guys have been stuck with, even though they've been borrowing money at 0.5% or 1% and being able to invest it at 2 or 3, they've got all this low interest paying paper. So if they're good managers, they're buying very short term paper because eventually interest rates go up, and now that they have all this paper is coming maturity, right? They're getting that money back and now they can invest it at 5% and they can borrow and they can buy on. Do you know how interest rates affect fixed income securities? They go down in price when interest rates go up. So now they can buy these securities at a discount and get a higher yield than what they're borrowing money. So it's a double good thing for closed end fund managers when the interest rates went up.
Oh, so
And
now
now
they're
they're
buying
and
fixed income securities? Is that
now
what
they're
you're saying?
when the money comes back in, they're cashing in a 1% note, and now they're buying a 5% note. It's just like if you had a corporate bond that was paying only 1%, it matured. Now you can go buy a corporate bond that is paying 5%.
Right.
It's more difficult than that. You have to find one, but that's the idea. These things are perfect for this type of an environment.
Right. When you say they borrow for short term, what is that term limit? Are we talking like months or
I,
years?
I've never done it myself, so I don't know. But I mean, there are closed end funds that say they're short term loans, maybe a year,
Right.
2 years, 3 years. If you look at any fund, any ETF, if you could look at their bond holdings, you'd see they are laddered maturities. I mean,
Right. Yeah.
so yeah. So the intricacies of it, I've never been a fund manager. I've been a money manager for people, and I've managed
Right.
millions, over 100 million actually, of that. And every portfolio was different. But I never borrowed any money,
Right.
from my
Do you,
clients or anything like that. So
right. But do you advise your clients to at least do some due diligence on the fund managers to see what their
Yeah.
oh,
historical
absolutely,
records have been?
absolutely. Yeah, I provide them, you know, I have universes of securities where the average, with the average yield, the average price, the average age. In the book, it it gives you 5 different quality checks of the CEFs. Has to have more than 50 securities inside. They can't be overweighted. The top 10 can't be overweighted more than 40% of it. They have to be in business for over 5 years. Blah, blah, blah. They have to have, you're not going to like this one maybe, they have to have a volatility in them. I like to see volatility because that means I can take profits more often. I can trade them.
Right.
Okay. So these are the things you look for in closed end funds. And you have to develop diversified portfolios. I mean, the whole scenario, there are 6 basic principles of investing that apply to closed end funds and every other type of vehicle you want to invest in. Quality, diversification, income generation, profit taking. Profit taking is one of the key pillars of risk minimization. Understanding that there is a market cycle and how it works and how you can prepare for changes in the market cycle so you can take advantage of them. When the market's high, you buy less of something because you expect it to go down, and then you could add to your position. When the market's
Right.
down, you buy a little bit more of it. That type of thing. And the final thing is, what are you trying to accomplish with this portfolio, fellas? What is your objective? What do you want to do? Do you want to prepare that income I talked about to pay your kids' education or to get them through graduate school so you don't have to dip into your security principal? Or do you want to just build up your ego with these huge numbers that everything's worth? And then if you ever want to spend it, you got to sell something to do that. And then you got to pay Uncle Sam as well. I like to pay Uncle Sam every year for what I've made that year.
Right. What?
So
Go ahead.
one question I had is, for the just average at-home investor, how hard is it to do your own due diligence without the help of a money manager on a CEF?
It's not hard. There's a good website. There's a couple good websites. The primary one I use for my research is cefconnect.com. And they have all kinds of screens you can use, and they have tutorials, they have explanations, they make up all these categories. You can check all those things I just talked about and that are in the book of what you got to look at. That I actually send them there in the book. I don't say come
Right.
to me. I say go there. And when I send out these universes, when people get the universes from me, I tell them very clearly these are research tools. You have to know what you're doing. You have to go in there. What I buy for myself, you may not want to buy.
Did you say
So
universe? When you send universe, what does
I
that
send
mean?
when I put together a universe every month. I track all of the securities that I own, all the securities I want to look at to see what I own. I check how many securities are there, the prices, the yields, the distribution histories. I keep a spreadsheet of the distribution histories, what classification they fall in, so I can make sure my sector diversification is proper. Yeah,
Right. When you said securities, are you talking about the different types of CEFs you own, or are you
yes,
talking about the underlying assets?
no, the CEFs.
I see.
CEFs. I look inside of them to see what their underlying assets are when I first judge them to see if I want to put them in my universes.
Right.
I look in there and I say, oh my God, this guy's got he's got 25% of his assets in one security. Now, if they happen to be treasury bills, that's not so bad. But if they're, stocks that I've
Right.
never heard of, or even if they're a stock I have heard of, it's not a good idea. So I'll stay
Right.
away from that one. There are fewer than 500 closed-end funds that trade on the New York Stock Exchange.
Right.
And and that includes municipal bonds also. And
Right.
I own roughly 240 of those.
I
I
see.
don't own them all the time because I trade, But
Right.
that's what I'm looking at.
So in a CEF, like if we go back to the basic example where I only have Apple and Amazon, and I am the fund manager. As a fund manager, do I have the ability to add more stocks like outside of Apple and Amazon? Or can I only add more of Apple and Amazon?
The manager, a manager in a closed-end fund can add pretty much anything he wants to. Okay.
Oh, really?
And okay. Now I remember when we were talking before about crashes and things like that. This
Right.
is the difference. This is the difference. In a closed-end fund, the fund is separate from the manager. You own the part of the trust. You don't own the shares inside. So if you panic and you sell your closed-end funds, the manager doesn't have to sell anything. Okay? A mutual fund manager has to sell the shares to get you the money because you're dealing directly with that fund. And that's another one of the big differences. And I believe it's the same with an ETF. If everybody sells it, probably not because they trade like stocks also. So, but with the mutual funds, that's a huge difference. I call when people tell me that a mutual fund is managed, I say, yeah, it's managed by the mob. Whatever the mob says, that's what the manager does. Whereas with a closed-end fund, he's in charge. And when you've got a panic situation like that COVID little crash, or even go back to 87 and 90 and the Great Recession, mutual fund managers just sat back and paid out money.
Right.
Just paid out money because they couldn't buy.
I want to understand. So, like, if say, going back to the simple example, if there were like say 10 investors, for that bought the CEFs, and like 8 of them withdrew their money, then how will that not impact the underlying assets?
They're not withdrawing their money. They're selling their stock, and they're selling their stock to some other shareholders in the marketplace. They're not dealing with they're not dealing with the closed-end fund. It's not a mutual fund. Okay. That's a big hairy difference, really.
Right. No, and the other question I had was, so you mentioned like you have to do your due diligence on your fund manager, right? But if the fund manager has the ability to buy anything they want, like what happens in a scenario where the fund manager like goes crazy and does whatever?
Well,
right?
I guess it would be the same as in any business or development. You will probably will happen, but he's got these are companies like BlackRock and Nuveen and Eaton Vance. I mean, BlackRock's one of the biggest fund companies in the world. They know, I think they know how to handle their managers, and the guidelines that they put out, like in CEF Connect, you'll see the purpose. They'll write out the purpose for you in every one. You'll see the content of every one. They list all that stuff for you. So these guys don't really have the ability to go nuts on you.
Right. Are there like checks and balances in place?
Oh, I'm sure there are. Isn't there are any other managers? The reason I say I never buy one that's less than 5 years old is exactly for the type of questions you're asking. I want to know I want a proven track record. I want to see those distributions have been paid. I want to see where that stock's trend and the price has been. If you look at closed-end funds, you'll see they have a very narrow trading range. And there's a reason for that. The reason for that is they're paying out 95% of their earnings, so they're not going to grow. They're not going to go up like this. That's not what they're there for. They're there to produce money, produce income.
Right.
And they do it really well.
And from the perspective of, say, BlackRock, what's the advantage of creating a CEF versus another kind of fund?
Because they make more money compared to an ETF. I'm guessing.
You're absolutely right. The fee inside the fund, the fee that they get is higher, but that fee is not paid by the shareholders. The yield to the yield that's quoted on a closed-end fund, like if I told you that the average of my closed-end funds right now, the the 200 of them that are not municipal bond funds is over 10%. That's after expenses. I
But it's
never
still
ever,
affecting your yield, right?
it's still affecting my yield. Yeah, if they
Right,
didn't
because
charge a fee, I'd be getting 12% and 10%. You see what I'm saying?
exactly.
But
Right, right,
unlike the government, that says you can't have closed-end funds in a 401k because their fees are so high. The government says you can have a mutual fund that's paying 0.5%. It's only yielding 3% after expenses. But that's better than having a closed-end fund that's paying 3.5% in fees, but also paying 10% in dividends. That's the government logic. So
here's a
that's why you
question
don't.
I yeah,
So you don't see closed-end funds in your 401ks.
right.
So
Here's a question I
so
should have
most
asked sorry, here's a question I
go
should have
ahead
asked like 30 minutes ago. Why is it called a closed-end fund?
because it only has a limited number of shares. Like when it does its IPO, it says we're selling 30 million shares of XYZ as a closed-end fund trust. That's it. They're not going to they're not going to issue any more. They're not going to split their stock. They're not going to have secondary issues. The only way I know of that they add to the number of shares outstanding is through rights offerings. And occasionally they'll say, just like stocks do sometimes, they'll come out and say, okay, you've got the right to purchase shares at this price, depending on how many shares you already own. For every 100 shares you own, you can buy another share, that type of thing. That's the only way they can add to the number of shares outstanding.
And what
Mutual
triggers
funds,
that?
mutual funds do it every day. Every
Right.
day they add or delete shares. I'm sorry, what triggers what?
What would trigger the rights offering on a
Um,
CEF?
Whatever the company management decides they want to have more shares out for some available for some whatever reason. It's not
And
predictable. It's not the same. It's pretty much the same funds most of the time, but it's not predictable as when. And I don't read the prospectus to find out why, because I just take the money and run. I sell the rights and I buy something with it, buy something else with it.
You mentioned that before. You look for volatility, so you can take advantage of it, right?
Right.
So how do you like? I'm guessing volatility is something that you have to experience in the future. Not like how do you look at the past volatility
Well,
in the due diligence
yeah,
phase?
the past can tell you that, and if you look at any closed-end fund, you're going to see a lot of, and that's, you don't want to see just an upward trend or a downward trend, and you don't see that much in CES. All of them are pretty much volatile, and the volatility is what allows somebody like me to take profits on 7 different CEFs today because it went up a little bit. I can take the profit and I can reinvest it right away again at the same yield or similar yield, and
Right.
at a price that allows me either to start a new position, that something I've sold before, or to add to a position that's still down so that I can reduce its cost basis and increase its yield. So
Right.
and you do that, and the higher the market gets, the more closely you watch things to make sure you're taking your profits off the table, because eventually it's going to go down again.
Right. What kind of volatility can an average person expect on a CEF on a
Uh,
day-to-day basis?
on a day-to-day basis, about the same as you can on any stock. I mean, it's going to go up or down pennies, mostly pennies.
but
You
I'm
know,
guessing
rarely is there a dollars of
Well,
change in it in the same day.
But I'm guessing. So, say we're talking about an average investor who's just buying stock on their own, and they're looking for retirement income. They're probably not going to want to trade the stock that much. They're looking for CF purely for the sort of fairly
stable income.
stable income, right?
That's very true. That's very true. A lot of people do that. I find I thought, it's like I picture your table in front of you and picture it's got 200 buttons on it. Okay. There are 200 buttons there and they're all and let's say the average, they're all yielding 9%. So I have all these securities in my portfolio and they're paying me 9%. And 9% equals what? Less than 0.75% a month. All right. So in my mind, and I figure if I can make a 2% profit today, that's like 3 months worth of dividends, and I can reinvest it at the same level. I may even have gotten a dividend or two on this particular position I'm selling. I'm growing my capital, and every $100 of new capital I create, I can put that to work at 10%. It's just like if my rich uncle gave me I made $1,000 a day so far this year. It's like my uncle gave me a check. Here's $1,000, invest it and make 10%. That's what it is. You're creating new capital that you can put to work. I could take the same attitude, though, of an investor who says, well, look, I've got this 7-figure portfolio, and with these closed-end funds, I'm making myself $200,000 a year. I don't need to go in there and take profits and trade. I'll just live on that 200,000. So there's the range in between. A lot of people want to grow that capital so they get to the point where they're generating 200,000, and then they'll say, well, I'm not going to take my profits all the time, but I am going to, if I'm coaching such a person, I am going to tell them, that even though that market value going up makes you feel good, it makes you feel good, makes that ego grow, it's going to go away in the next correction. So if you were to simply sell half of your thing that's gone up so much and reinvest that 50%, you'll grow your income and you won't have that damage to your psyche when your market goes down, or like I guess a lot of people right now are experiencing it with Apple. Apple's gone down for 3 days in a row. Oh my God, it's that type of thing. I like to, I don't know. I like to see people take the most of it. You have 2 streams of income at your disposal. Like you just said quite rightly, you have the distribution income, which can be, depending on how much you have to invest, can be actually all you need. Okay, you don't do anything else. You go away, go on vacation, it's coming. That's one stream of income. The other stream of income that runs right alongside that is the capital gain income. I like to dip my feet in both streams.
So what would you do in a situation if we run into like an extended bear market? Like say it lasts 2 years.
We just had one.
2
Do
years?
you know that the market
January 3rd. 2 years?
January 3rd, 2021, the S&P 500 hit a new all-time high of 47.97. It has not gotten to that level since. In November 19th of 2021, the NASDAQ hit 16,057. It has not gotten there since. That's more than 2 years. So we've been the only one that's above where it was at that time is the Dow. So we've been in a correcting market. In my mind, a correcting market is when it's not growing, it's not setting new all-time highs. So it's been 2 years. So
and the
yeah.
CEF
And CEFs, and my income on CEFs, you're adding 10% to your, and generating 10%, you're growing your income by probably 20% in that same period of time.
But what about profit taking? Since you cannot do profit taking in a bear market.
Can what?
You can't take profits, right? In a bear market.
There won't be some. Even a bear market has, what do they call them? Dead cat bounces.
Right.
Where it goes up for a couple of days. You can take if you're doing this according to the book, you are adding to positions on their way down. If they go up a little bit, you might be able to take a couple 2 or 3% profits in between. So there'll be some, but certainly not like in 2021. In 2021 was it was pretty much a good time for me to get ready to sell the business because it was the best year ever. We have a large portfolio of over 100 million, right? Over 7 million in distribution income and another 7 million in capital gains income. So the person who's happy and is sitting there just getting their distributions, right? Say that person had that 100 million. That person would have foregone another 7 million in capital gains. So my advice to people, my coaching is know that there are two streams of income in existence and take advantage of them as you can. If you don't want to do it every day, that's fine, but don't lose sight of it totally.
From a tax perspective, though, you're paying higher in capital gains, right?
Absolutely. Yes. Unfortunately, they didn't have Roth IRAs when I was a young man. So all my money went into a regular IRA, so it's all taxable on the way out. But people today who have Roth IRAs can do what I was just talking to you about, and they can build a tax-free, a huge tax-free investment portfolio for themselves using the Roth programs.
Roth is where you pay taxes when you take the distribution, when you take out the money. Is that correct?
No. That's regular IRA. Roth IRA, you put in money after tax income. You've paid the taxes and you put it in there, and then it never gets taxed again. I think there are some strange rules, some IRS rules that are that can be messy, but I don't know what those are. I'm not an accountant, so I don't really know. But,
fair enough.
But that's a big advantage. I encourage people who have Roths to adopt this approach of income generation.
Well, we've talked a lot about CEFs, and I know that you almost exclusively invest in them, but cryptocurrency is still a major trend. So what are your thoughts on the cryptocurrency market, and should investors look at it or should they run away?
I've run away. I'm a 50-year experienced investor, and I wasn't even tempted. I don't understand it, and I don't invest in anything that I at least don't, mostly understand. I don't invest in anything that doesn't pay me interest or dividends, and I don't think crypto pays anything. The price per unit is ridiculous. How could it doesn't make any sense to me when I wouldn't be able to sleep nights. And I've gained followers from their experience in crypto, and I've lost one client in my life to crypto. 2 or 3 years ago. That had to go there, and I refused to do it for them. So, it wasn't going to happen with me. So no, I am not a crypto fan. I'm not a fan of anything that doesn't pay me. I don't buy anything right now that doesn't pay me at least 6% income.
Right.
In the taxable, in tax-free, it's got to be at least 4%. So those are my limits, and it's got to, so it's got to pay a dividend. It's got to. I don't know what kind. I don't even know how to buy. Can you buy it on the stock exchange, or do you have to deal with somebody outside? I have no use for stuff like that.
Right.
I'm
guessing most of your target audience is also people who are about to retire or have already retired. Correct?
Well, yeah. Like I said, I think there's a lot of younger people who would benefit from putting stuff away in a more income-focused environment. Over the years, I've inherited people with IRAs that they've had IRAs for 4 years, and they've got $2,000 in the IRA, and they put the maximum in each year because, I'll take a flyer on this, I'll bet on that, I'll do this, I'll do that, and they always lost their money. You know,
Right.
the smaller your portfolio, the less you've got going, the safer you got to be, the less risk. When you get up to six figures, go ahead, knock yourself out. Take 10%, gamble until you lose it, learn a lesson, and then go back to being safe again. In you can have as a young person in the 30s and 40s, you can have a 70% equity portfolio and still be getting 9% income in closed-end funds and experience all the thrills of the stock market. I don't know why more people don't use this vehicle. I do know why, but I don't want to be critical of the establishment that bases everything. Anybody's in the investment business as an advisor in an advisory capacity these days, now that commissions are gone, the key element that they're paid on is AUM. Do you know what AUM is?
Assets
Amount
under
under
management.
assets under management. And
Right.
assets under management are measured in terms of market value. Like I could be making my clients 10% income every year of their life. And if the market value went down, there's likely to be somebody up there that wants to tell me I should be doing something differently.
But the
So
CEFs
it's a
also own a lot of assets, especially they're taking out debt and adding to them. So why is
yeah.
that not contributing towards assets under management as well?
The market value is not their emphasis. Your market value is going to grow with the market when it goes up, but not as much as the stock market is going to grow up. And people, if you look at your managed portfolio, if you have one, it's going to be primarily in the stock market because that's where the action is. That's where the AUM is. And that's model portfolios. I've seen them pretty much all in the stock market. The emphasis is not on income. I think that's a big problem. I think that's a big problem.
Why are
But
they getting paid more for having a larger AUM as opposed to having a larger
that's
income
how,
generating?
because that's how it
What's the
works.
root
That's how
cause?
they get paid. That's what's the root cause?
Like, yeah, what's causing that?
The way people look at investing is purely as a market value. It's a market value business. They aren't like me. they they don't understand me.
Right.
They don't want me around. I don't think. But I mean, I've had an awful lot of happy clients over the years because they've gone around the world on the income I've provided for them, just like I have on the income I provided for myself. You know,
Right.
and they people have to. I've spoken with people. Oh man, when we had that big run up before the dot-com bubble, I went out and I bought myself a BMW. And I said, Stan, you're one of the few people that made money from the dot-com bubble because you didn't hold around until the crash, to take a profit or anything. You took a profit and you bought something with it. Most people don't do that. They don't do
Right.
that. They know that stock is going to go up forever. And the thing about closed-end funds is you own those very same stocks. And the guy who's managing this closed-end fund, when that thing goes up 10%, he's probably selling it, just like I would sell this CEF. And another amazing thing is I'm going to sell that CEF 2 or 3 times a year. And then at the end of the year, when I add up all the dividends that I get from that CEF, some of it's going to be capital gains, long-term capital gains that I'll get yet again, that I'll pay long-term tax on instead of short-term. So
Right.
it's just, to me, it's a safer world than the stock market, much safer, because
Do
I'm
you do
getting a
you have
lot of
a
it.
sorry, do you have a rule for when you take those profits?
Oh yeah, oh yeah. I never depending on where we are in the market. Like sometimes when the market's down, any profit is a reasonable profit. But as we go up, like recently, we've had this rise in the stock market part, not the interest rate part. I've been taking 3% profits, 4% profits, stuff like that. But
Right.
in 81, or not in 81, in 21. In 21, I was taking 6 and 7%, and I take that twice a day. I take my 3 largest profits twice a day, and sometimes you don't want to take them all because then you have all this money to invest. So
Right.
I twice a day I'd go in there, I'd take 3, 7% or better profits, be happy, rack it up, and reinvest it, and I keep doing that. And then as the market went down, I do the same thing. I try to take my top 3 profits every day.
Right. It
Sometimes there
seems
aren't
like,
any.
yeah. So it seems like you have a working strategy. So I'm curious to know why you stopped or you closed the fund that you had.
It's not a
You
fund. I
say,
didn't have a fund.
oh, as
I,
in like
I
you
was a
used to
I was
manage
a
money
private I was a
portfolio.
private I was a private investment manager. I had 110 million under management with me and 140 clients. I sold my practice. I sold my business. That's why I stopped. And I'm 78 years old, so I had a good reason for that. I wanted to spend, you know, probably more time than I will traveling the rest of the world that I haven't been to already. So yeah, that's why I'm not doing it anymore. I'm doing it for myself.
Right.
I'm doing it for myself. Here's my the list over there on the left is the list of things I'm selling tomorrow. So
Good thing this video is not live.
Yeah.
what? Oh, you're gonna have to cut that out.
No, I'm saying good thing we're not live right now. Like people can't hear us because then they will know what you're selling.
Oh, they wouldn't have seen. Could you actually see the symbols?
Well, I
Yeah,
guess
but
we'll
you
find
see,
out.
well, I'm taking profits now. If you sell them, that's another thing. Most people sell out of hate, right? Think about the things you've sold in the past. You got mad at them because they went down. You couldn't stand them. You never wanted to see them again. You sold them. I sell out of love. I'll sell the same thing 3 or 4 times a year. I'll sell it. A month later, I'll buy it again. I'll sell it again. They're just those push buttons on the table. I've
Right.
already vetted them. I know about them. I trust them. They've been good to me over the years, meaning they continue to pay the distributions. That's their job. And so when I sell one, I'll replace it with one of the others. It's gotten to be that routinized. So it's
What's
fun.
your What's your favorite closed-end fund?
I have over 200 funds that I own and that I trade frequently. I can't say that in a public place and not be interpreted as a recommendation. I'm sorry.
Ah,
Right,
okay.
yeah.
I'm sorry.
And for the novice investor, any tips on how to take emotion out of the
Oh, yeah,
trading
you just have
process?
to. You've got to set targets. Just like pretend you're Walmart. You got all this stuff on your shelves of your store, right? Somebody comes in, they want to pay your markup, you sell it. Put something else on the shelves. That's how you got to think about your investment portfolio. It's a store. That's how I used to, when in common stocks, it was very easy to describe. You got this guy that produces lawnmowers, and this guy has chainsaws, and this guy manufactures cars. You have all these things in your store. Somebody wants to buy them, you sell them, you find something else. Now I have shopping centers on my shelves because I have multiple portfolios of multiple securities. So I've got a big shopping center in front of me instead of just a little store. That's the way I look at it. That's why I think if somebody takes that look at something, they'll go far in investing.
And so for anyone who wants to learn more about CEFs or would like some advice, how can they contact you?
And the book.
Well,
Of course, how can they get your
well,
book?
the book is at Amazon and every place else. It's called Retirement Money Secrets, and it's doing pretty well. But anyway, that's I think that's a good thing. You can determine if you want to do it yourself. If you want to get a manager, if you have a manager, you can determine. You can give the book to him and say, "Hey, this is what I want to do." And if he doesn't, then you find somebody else that does. And I have a coaching business where I help people understand where I help people with conversations like we've just had, probably not as detailed or as in depth as we went in some issues, but generally, to talk to people about closed-end funds, but more than just closed-end funds, about income investing and that focus of focusing your investments on the income you produce and growing that income so that income will take the place of your salary when it needs to, or if it'll pay for your kids' education. In my case, my grandkids' education. That's what you're looking for. You're looking to get to that point where you can do what you want to do because you have enough income to do it, even if you're not working.